Good afternoon, everybody. Welcome back to Markets for Millennials for a quick update, weekly wrap of January 24th to 28th. Obviously, some big things happening this week. We had the FOMC meeting, where basically they just confirmed what they had already said that they were going to do. The response in the markets, as we look at this candle right here on the S&P futures, green to the upside, but then we sold it all back, and actually ended up, even though this candle is green, it's because the candle started so low, or opened so low. It actually came up, and then we sold it all off and ended negative for the day. And that was like that across many of the markets. Gold and silver, if you just take a look, we've just had a really bad last 3 days. Basically, all the momentum that we had to the upside in gold has been given back. We're back below all the moving averages. Same thing on silver, just gave it all back after bouncing off the 200-day moving average. So we'll talk more about gold and silver in a second, but I just want to kind of go over something that I'm seeing across all the markets. This is where you want to be really, really careful in this situation. The question that we're asking here with this video is now the time to buy the dip? Are we bottoming right here? And the reality is this is probably a good place potentially to take a partial position, but my personal view is that you should hold off and wait for clarity. The sidelines is a position of power, as we say in CTM. And the reason why I want you to be careful is if you look at the S&P, and I've got my blue 50-day, yellow 100-day, red 200-day moving average, and we, on a couple of consecutive days, have failed to get our price action to close above that. And today we're closing right underneath it. And my concern is that as we go into next week, you never know what's going to happen over the weekend. We could end up bouncing off of it and moving down even further. Our current correction, as we close today from our top, we're currently closing at 8% below our top. And it's worse on the NASDAQ and the Russell for sure. So what you're seeing here is similar on all the markets. Here we have the NASDAQ, which is actually much further below its 200-day moving average, having made a lower low than what we had in October 2021. The Dow kind of bouncing around. Hasn't really made a lower low, but it's interesting to see the extent of this range. It's really interesting. It's almost like a sort of like a megaphone, not exactly, but it's kind of a widening sort of range that's happening. I think that that's interesting, and I think that the Dow is, instead of bouncing off of its 200-day moving average, it's bouncing off this trend line, which was established from over here. So again, it's a situation where I'm thinking, man, like it'd be really easy to go to the downside. So this is actually setting up well for potential short positions, obviously with responsible stop losses. The Russell, lots of downside momentum already on the Russell. So these are in a precarious situation where you want to be careful not to chase the momentum to the downside because you never really know when you're going to catch the bottom. But for if anybody is looking to take short positions, again, my point is that these are setting up pretty well for short positions. So what you essentially do is you look for the follow through down to the bottom, down to the downside. And a good practice is to take the bottom of the wick, right? So obviously you're going to miss some of the price action here. So if we go to the wick from that, it's over 3%. But that's okay, because what you would do then is you wait for price to cross below that wick. That's your entry, and then you set the stop loss at the top of this wick, right? And then that's a good risk to reward, because then what you're looking at is potential, like depending on where you're targeting to the downside. You can get some pretty good, pretty good take. But then also it'll protect you, because if we don't, and honestly, like maybe I'm not being clear, so I'm going to try to slow down a little bit. The reason why you want to take this as your entry rather than, because a lot of people would say, well, why don't I just take the short now, right? Well, then the problem is, where do you put your stop loss? You would basically have to put, try to automate this again. You would basically have to put your stop loss up here. That's the, or potentially up at the top. That's the only responsible place to take, to put your stop loss if you're taking a short from off of this. And then the problem is that if your stop loss, if you don't take the position down here, if you just take the short right now, or basically as soon as trading opens on Sunday night and Monday morning, you don't know what price is going to do. Price could come down a little bit, but then it could shoot right back up. We could get a counter trend rally. So that's why you got to wait, and you have to put the entries in the right spot with the proper stop loss. Otherwise, you're just going to probably end up taking far more losses and far bigger losses than you want. So again, it's all about strategic risk management. Okay, you want to be able to place your positions properly, and you want to place your stop losses properly, right? And it's much harder to catch to the downside because if you just pull back, the markets generally go from the bottom left to the top right over time. So if you just hold for long enough, and any long position will eventually most likely be in profit. And so that's something that you want to remember. It's harder to taking a short position is much harder because the trade can move against you much more easily than taking a long position. So anyway, because of that, on all markets, you could take the same principle if you just look at the NASDAQ here. Again, if you were thinking of taking a short position, then your entry is here, and then your stop loss probably is going to be here at the top of this wick. And if you want to be even safer, you'd put it there or potentially up there. Those are the only responsible places to put a stop loss on a short position, and only if you're taking the position, like your entry is going to be at the bottom of that wick. Okay, same thing on the Dow, same thing on the Russell. But otherwise, the sidelines is the best place to be. That's my personal opinion. That's where I'm staying. So all of those things that I just told you, I'm not doing that. I'm not going to try to take the short position because I'm not trading on a short time frame. I'm trading on a longer time frame, investing on a longer time frame. Okay. The DXY, we're at a level that we haven't seen basically since, where is this level? We basically haven't seen this level since July 2020. Kind of a big deal. I put this yellow line because I want to see if we're going to be able to retest this and keep resuming up. And if we do, there's not a lot, honestly, between here and 99 or 100 in terms of real resistance. And so that's something that could potentially happen. Or is this going to be a fake breakout? Are we going to come back down? As you can see, all the moving averages, even though I don't usually use the moving averages, especially on the DXY, they're all pointed upwards pretty extensively. So all the momentum is to the upside, and has continued to be ever since basically mid to late May of last year. Yields, interestingly enough, so we had a big move up on Wednesday with the FOMC meeting, when they basically confirmed that they were looking for the opportunity to raise rates. They were thinking about raising rates with nothing actually confirmed yet. And then since then, we've come down. We've almost given all of that back. We're just barely above the open on Wednesday. So yields kind of remind me of this area, the kind of in October with the price action. We kind of are failing to make a higher high. So we'll see what happens with it. I'm looking again at this 2% spot. As you can see, if you go back to before the March 2020 crash, this level provided resistance. And obviously prior to that, it was support for a considerable time. So I'm watching that level. That's where I think the markets will have even more trouble if yields do get that high, and that just might happen. You just have to be prepared for anything. Mentioned earlier, gold and silver kind of puked. As we've seen on gold for a long time, anytime we've gotten a sustained move to the upside over a period of a month or so, or maybe 2 or 3 months, gold has kind of puked it all back. Now, I previously said because of what was happening here, it's really bad, because of this kind of action. I feel like we're kind of bottoming, kind of rounding into a bottom. But as you can see, we failed to stay above this trend line right here. So I was getting to the point where I even said last week, we're starting to get to a point where the positions that you're gonna want to start taking positions on gold, whether it be futures or on the GLD, and then with silver futures, and then SLV, and potentially also spot. But now this isn't looking as good in terms of like the near-term price action. So something to be watching out for. Not exciting. Not good. Oil continuing its march up. I feel like this price action is not sustainable, but look at how many times it's happened. It's going to get to the point where oil is going to be politically a problem, and so that's something you have to watch out for as well. Just be careful about chasing momentum. I myself am not buying oil, but if you're looking for a position in oil, at this point, it's a discussion of where you believe oil is going in the long term. If you believe that because of green energy and because of the shutdown of oil wells and all of the stuff and inflation, all the narratives going on, and you believe that oil is going to continue to go up, then it might just be best to just buy, because market psychology at some point, people right here as price is going up get really excited, but then they're like, well, I'm not going to buy. I'm going to wait until price comes down to like 70. Well, then look, it comes down below 70, but people get fearful here, and then they don't buy. So definitely something that if you believe in it long term, you just buy. Not financial advice, but you just got to, again, it's a situation. You cannot, look at all the stuff. If you just pull up, different, different indices and stuff like that. I don't even have all of these listed in my watch list. There's too many things. You can't take action on everything. So you have to be selective and pick your spots. But anyway, so that's just a quick look at oil. Bitcoin. I actually think we're down. We've hit the bottom for Bitcoin. I don't know, but it just seems like every time we've gotten moves to the downside, they've been bought up. We've got good fundamentals, which I know people have been saying for basically this whole all of 2021. The fundamentals were good. It's another situation where people want to call this a bear market, but if this is a bear market, then this was a bear market, and look at how fast it came back up. And so, you just have to remember, if you believe in Bitcoin long term, too many people trying to get rich tomorrow, but if you believe in Bitcoin's viability, if you believe in its fundamentals and its use case, if you believe all those things, then why would you buy here instead of buying, instead of waiting until price makes another new all-time high and then you miss out on all that upside price action? That doesn't make any sense. So anyway, I think that to me, I feel like Bitcoin is hitting a bottom, but obviously you want to wait for confirmation above this trend line. This is kind of, I guess, our new most important trend line in crypto, kind of like what this one was. But then obviously once we cross above this, we're going to have to retest some levels. Obviously, I'm looking at 42,000 as a big important level. And then I'll be looking at about 52,500, and then obviously levels above. So a lot of work to do on Bitcoin, but it's a situation where if in this particular cycle, if you bought early, then you're in profit and you're fine. No reason to get greedy or to get impatient. Don't try to become a day trader or an expert just to get yourself a little bit more, because if you try to do that, try navigating this honestly. What do you how are you going to do it? Okay, most people, if they try to day trade, they don't profit in the end. Most people are losing traders. So just something to keep in mind. Anyway, I know it's a quick look. I could have been more thorough, but obviously, for me, my own personal view is that We need to be in a holding pattern. That's the position I have right now. I'm not taking new positions. I'm just waiting for clarity. I'm waiting for the entries to show themselves. I'm waiting for the trend lines to be broken. I'm waiting for the moving averages to show that momentum is moving back to the upside. And I'm doing nothing until then. So I'm trying to act out what Jim Rogers once said, which is, that sometimes the best thing that you could do is just wait. And for him, he used the idea of, I'm just going to wait until I see money on the other side of the room, and then I'm just going to go pick it up. So you don't have to be in a rush, because if you're in a rush, you're in a rush to lose money. Got to wait, pick your spots, be responsible with your entries and with your stop losses, and that will help you to be a more successful trader. So that's the look at the markets this week. Obviously, things are precarious, and we'll see what happens next week. Thanks again for watching. Go ahead and like and subscribe and share if you have not. And I'll see you guys next week. I hope you guys have a great weekend and a great trading week next week.